Hello everyone and welcome back to Explain the Charts. Today on November 12th, 2025, we are diving deep into Litecoin, or LTCUSD, which has just had one of its most explosive weeks in recent memory. The market is buzzing with activity after LTC reclaimed the critical $100 level, and today we're going to break down all the news and what the charts are telling us about where it might go next. First, let's cover the massive wave of bullish news that has been driving this recent rally. The biggest story is undoubtedly the influx of institutional money, spearheaded by the launch of the Canary Capital Spot Litecoin ETF, ticker LTCC. This ETF has seen impressive inflows, recently pulling in over $2 million on a single day and bringing its total assets to over $6 million. This signals growing confidence from professional investors, a trend further supported by reports of a 6% increase in whale wallets holding over 100,000 LTC in just the last 3 months. This big money isn't just sitting on the sidelines. On-chain data shows transaction volume has surged to a record-breaking $15.1 billion, indicating a massive increase in network participation. Analysts are even drawing parallels between Litecoin's current chart pattern and Scasha's recent explosive 685% breakout, suggesting a massive upside potential if history repeats. However, it's not all one-sided. Some analysts are warning that the rally may be fragile, driven by short-term speculation rather than sustainable growth. With many long-term holders now in profit for the first time in months, the risk of significant profit-taking is very real. Furthermore, reports note that core development on the Litecoin network has been relatively stagnant recently, leaving the asset's price heavily reliant on market sentiment and ETF hype. Now, let's see how all this news translates to the price action on the charts. Looking at the full daily chart for LTCUSD, we can see the broader context of the recent move. After hitting a significant low back in August 2024 around the $50 mark, the price has been in a long period of consolidation and recovery. We saw a major peak around $147 in December of last year, which now stands as a long-term target and major resistance zone. The price action has been contained within a large-scale pattern for years, which many news outlets are referring to as a massive symmetrical triangle. The recent price explosion can be seen as an attempt to finally break out of this long-term consolidation. Notice the sharp drop in early October, where the price flash crashed to around $55 before staging an incredible V-shaped recovery. This dip likely fleshed out weak hands right before the major move up, a classic pattern before a strong rally. Let's zoom in on the action from the last couple of months to really see what's happening. Here is the daily chart starting from October 1st. After recovering from that October dip, the price consolidated in the $80 to $95 range. Then, on November 7th, we see this massive green candle, a monstrous 17% gain in a single day. This is where the price decisively broke through the $87 resistance and shattered the $100 psychological barrier, closing above $101. This candle lines up perfectly with the news of record on-chain volume and major ETF inflows. This is the footprint of institutional buying. The momentum continued, pushing the price to a peak of $113.69 on November 9th. However, the last 2 daily candles have been red, showing a pullback from those highs. The price has now dipped back below $100, closing yesterday at $99.61. The critical question now is whether this is a healthy consolidation and retest of the breakout area, or if the rally has run out of steam. Switching to the 1-hour chart gives us a clearer view of this pullback. We can see the powerful ascent to the $113 peak, followed by a sharp rejection. The price then failed to hold the $106 to $108 zone, which had been a brief area of support. Breaking below that level signaled further weakness, leading us to where we are now, battling around the $100 mark. Losing the $100 level on an hourly and daily closing basis would be a short-term bearish signal. The next major support area to watch on this time frame is the zone from $95 to $97. This was the key resistance that held the price down for weeks before the massive breakout, so we would expect strong buying interest if the price dips to this level. This is known as a support/resistance flip, and it's a critical area for bulls to defend. For an even closer look, let's jump to the 15-minute chart. Here we can see the microtrend of the last 24 hours very clearly. It's been a consistent pattern of lower highs and lower lows, confirming a short-term downtrend. This price action reflects the profit-taking and consolidation we've been discussing. Traders will be watching for a break of this downtrend, perhaps a move back above $101 and a higher low as an early signal that the pullback might be over. Until that happens, the bears have control on the lowest time frames. Returning to the daily chart to put it all together, we have a clear set of levels to watch. The bulls are looking at a very bullish picture on the macro scale, driven by strong fundamental news. Their immediate task is to reclaim and hold the $100 level. If they can do that, the first major resistance is the recent high around $113. The truly critical resistance zone to watch is between $118 and $123. This area is cited in multiple reports as the point of control and a key technical hurdle. A decisive daily close above $123 would likely confirm the next major leg up, with targets at the multi-year trendline resistance around $135 to $140, and eventually the 2024 high near $147. On the bearish side, if the selling pressure continues, the first line of defense is the support zone between $93 and $95. This area represents both the value area low from on-chain analysis and the technical breakout point. A failure to hold this level would be a significant sign of weakness, likely leading to a test of the $87 to $90 region. The ultimate line in the sand for this bullish structure is the November low around $80. A break below that would invalidate the entire breakout and suggest a much deeper correction is underway. So, to recap the key takeaways and potential scenarios for Litecoin. The key support level to watch right now is the $93 to $95 zone. Bulls must defend this area to maintain momentum. The key resistance to break for confirmation of the next leg up is the $118 to $123 zone. Our primary prediction, with about a 65% probability, is bullish. Given the powerful catalysts of ETF inflows and whale accumulation, this current pullback appears to be a healthy consolidation. We expect the price to find a bottom in the $95 to $100 range before making another attempt at the $118 resistance in the coming days or weeks. Continued strong inflows into the LTCC ETF would heavily reinforce this scenario. Our secondary, more bearish scenario has a 35% probability. In this case, profit-taking overwhelms the new buyers, and support at $93 fails to hold. This would likely lead to a deeper correction towards the $87 breakout point. A significant downturn in the broader crypto market or news of ETF outflows would increase the likelihood of this outcome. Also, keep an eye on the November 15th options expiry, which was mentioned in market reports and could introduce some short-term volatility. Thank you for joining us on Explain the Charts for this in-depth analysis of Litecoin. If you found this breakdown helpful, please hit the like button, subscribe, and turn on notifications so you don't miss our next video. Remember, this content is for informational purposes only and is not financial advice. You should always conduct your own research and consult with a professional before making any investment decisions. Trade safe, and we'll see you next time.